What's going on, everybody? It's Jeff here. Welcome back to the channel. All right, guys, last video I made was talking about the options chain, specifically with AMC, and also the idea that call flow or put flow will influence a stock price in both the positive direction and the negative direction. I've been playing options for many years now, and there's a reason why unusual whales saying is follow the flow. It's twofold. One, yes, there are some insiders that probably do know about news before the fact, but a lot of it is because if there is heavy call buying, it's a good indication that it will actually drive the price forward and the inverse on the way down. So in this video, after a few days and more information being passed around the internet, I think people are missing two main things, and I'm going to cover that in this video. Let's get right into it. First off, I screenshot this from yesterday. I wasn't able to make a video. These are all of the AMC call options that expired out of the money. You have volume and you have open interest to the right. As you can see, this is only up to 29. If I jump over to this screenshot, there is more, and all the way down to that $51 strike, 13,000. That doesn't even include what is set for next week, the 14th, okay, because it's a short week at the $60 strike, 50,000. I mean, 18,000 at 50, it just gets to be a little bit insane. And there's a couple things that are happening. One, yes, I do believe some of this flow is happening from retail, okay? And I understand everybody wants to try to hit it big. Some of us, did catch that massive run up in June, had those options. I mean, I had long dated ones in January and short dated ones that went thousands of percent. And yes, obviously, I know some people do want to catch it again, but there's also another thing that is happening, and this talks about the hedge funds. And I really want to clarify, and yes, guys, this might just be my opinion and what I've learned, but I really want to clarify what a hedge fund's goal is, what a hedge fund's job is, okay? So first of all, as you can see, this most recent 13F filing from Susquehanna, you can see both massive flow on the put side and on the call side on interest. They did close some of their long positions they had from a 499 average, 71%. We're not going to talk about that. We're going to talk about both the call side and the put side. There is a couple main goals for a hedge fund. One, it is to attract new assets, and two, stay in the game. That is why hedge funds that are long on a position will buy puts, and that are short on a position will buy calls. It is to offset their risk, meaning if a hedge fund is short a position and it squeezes and rips, their calls are going to offset some of their losses on their core position. It's also called trading around the core. But before we even get into that, and before you even get to thinking to yourself that this is what you should be doing, let me talk about just hedge funds in general. So first of all, guys, here is a chart of the average hedge fund return compared to the S&P 500. And before I get into talking about this, if in 2021 you were actively investing and trading in the market throughout the entire year, okay, and I understand if you're new, you're still learning, all right, and that's completely different. But if you've been at this for a little bit of time, 3 to 5 years, okay, let's say even just a few years, and you did not even match the S&P 500 and you're actively investing and trading every single day, well, chances are that you should just invest in the S&P 500, because inevitably your job as a retail investor is to have your capital grow, okay? And if you can just invest in an S&P 500 fund, then there's the reason to do it rather than trading, especially if you're not matching the market, all right? But let's talk about these hedge funds. In 2019, average return was 10%, while the S&P 500 was 31%. The top 10 largest funds right here, 7.5% in 2019. You look in 2020, 11% versus 18%, okay? Now, hedge funds naturally, okay, do not outperform the market. And there's a reason for that. From January 94 to March 2021, through both bull and bear markets, the passive S&P 500 index outperformed every major hedge fund strategy by over 2.5%, okay? If you look at this article right here, this is, talking about why hedge funds can't beat the market. Okay. The key from a hedge fund is to obtain a much more stable return. so that the risk to reward ratio is actually better. Meaning, if the S&P 500, gains 20%, for a year to date, let's say, 2020, naturally, that's fine if a fund only does 10 to 11%, because inadvertently, if the market pulls back 20%, a fund is only going to maybe hopefully lose on the downside 3 to 4%. So that could be very attractive, okay, for individuals that have millions of dollars. That's why somebody with, a couple $100,000 doesn't invest in a hedge fund. Maybe a couple $100,000, but a lot of them is $1 million minimum. And there's a reason for that. Okay, their job is not to outperform the market. So if you're thinking to yourself to follow what they're doing, well, just remember that they underperform the market most of the time, if not all of the time. Here's another one. The S&P 500 index outperformed hedge funds over the last 10 years, and it wasn't even close. Here's another one. And Warren Buffett even stated in 2007 right here, a famous bet that an unmanaged low-cost S&P 500 stock index would outperform an actively managed fund every year from 2011 all the way to 2020. You can see the S&P 500 index and the average hedge fund index. And yes, there are funds that do go under because of operational issues, because of investment issues. Okay, we saw some serious screw ups, especially last year, Melvin Capital and so forth. And we understand that. But we're talking about the average fund, which includes some of the large funds. Credit Suisse has another, chart in comparison that they did. So now that you understand, what a hedge fund's goal is, and I get the manipulation and so forth, but their goal is not to outperform the S&P 500. So before you get to thinking to yourself to follow what they're doing, just know exactly where they stand and why they're doing it. Okay. Now, for a long time, I've been invested in AMC since January of last year. I mean, it's been over a year now. But that does not mean I haven't still been playing other stocks. Every single day I put out a list of options, because I'm heavily into options. It was a little bit different last year. My portfolio was much larger. I started really shrinking that down, in about August. Once you could see that, the Fed was starting to change their policy. But every day I put out these options lists to know the move before the move. A lot of people are looking for alerts. I still have never met one individual that has said, yes, I've been successful over the last 10 years only following alerts. So therefore, I try to give everybody an idea before the move so they know what to expect. And every single day, most of these, all right, if not all of them, will perform in one direction or the other. Okay, so keep that in mind. But when it comes to the options, and we talk about the amount of money left on the table on the upside for AMC, in my opinion, that doesn't always say go to play the downside of AMC. The reason being is because heavy flow can dictate some of that direction, all right? But here is the whole other picture that I said. You can have your investment and still invest in the thousands of other stocks that are available. And I will tell you, I will give you guys some advice. If you're new to options, I recommend everybody start with the SPY. It is very, very liquid. You don't have to worry about limit orders versus market orders. You don't have to worry about bid-ask spreads. Volume, it's there. It's such a liquid ticker and it moves a little bit slower. So it's a very good way to learn. If you are interested in trying to hit some of those home runs and swing, well, every single Monday, Wednesday, and Friday, there are options in the SPX, right? Now, it's a little bit higher of a ticker, obviously, because it's the actual index that you are betting against, or betting towards, But you can see some of these. This is actually one that I played on Friday, all right? It expired at 0, all right? I got into this at 55 cents. My goal was 200%. I said to everybody inside the group, got up to $1.40, just shy of that 165. I chose to exit it. But if you look at Thursday, the movement that happened, could have picked up this stock at this option at 185, and within a couple hours ran all the way up to 15. So if your interest is to try to swing and hit big, which I allocate a very, very, very tiny percent of my portfolio to be able to play some of these. It's more of a fun and exciting. If I have a losing week and it's a Friday, you better believe I am not going to try to get my money back on this. But the point of the matter is there are plenty of other tickers to where you can play the upside and downside that also is not manipulated. Okay. We know that AMC is very manipulated. All eyes are on it. The options chain's manipulated and everything. If you want to play a ticker like the SPY or the SPX, it is so liquid and there's so much volume that the manipulation that happens from this, if it is a big fund like Goldman Sachs that's really trying to change the direction of the market, it's not as easy as a snap of their fingers because of the amount of action involved in this. Okay, so guys, in this video, I know I covered a lot when it comes to what the jobs actually are of a hedge fund to be able to attract, all right, new assets in order to get that management fee. That's how they make their money. Okay, but also talking about other tickers outside of the one that we are all holding. So guys, that is it for this video. If you want to learn more about options, first link in the description. Love to have you guys come check it out. See you in the next one.